friends, this is Martin from Secrets, the channel for learning about trading and investing. Welcome to weekly stock market analysis show, where we analyze the charts and study and understand what happened in the market during the previous week, and then plan for a better trading a week ahead. That's starting from Tuesday, January 23rd, 2024. So we have the summary here, but we'll first go to the charts and then have a look at that. Here is the very weekly charts that we have been referring to since long. There was a consolidation at the top, the last, and you can see that it is cracked down in the case of Banknifty, and we had multiple flag breakouts and cup and handle breakouts that happened on the weekly charts. And also we see that the momentum has taken a dip, but a sharp dip in the case of Banknifty, a sharp fall in the Banknifty as well, right? Yeah, so this is another view. This is again weekly charts. You can left side Nifty and right side Banknifty. You can see that it's a wide range bearish candle, and that's also a trap after hitting the top of the channel trend line. And Banknifty also, we can see that it's a trap and it is a wide range bearish candle, still well within the parallel trend line channel that we have been talking about. This is a daily view, some consolidation at the top, but it's trending up and up on both indices. This is a candlestick view. The last candlestick, as we had seen, it's a wide range bearish candle. It's a bearish engulfing. It completely engulfs the previous candles within that. So that can turn out to be even more bearish in the coming weeks if the price moves below this week's candle low. In the Banknifty also, it's a wide range bearish candle. It's a bearish engulfing as well, and it can turn out to be even more bearish if it breaks below the previous candle's low. You also see that it's at a support zone from where the previous breakout happened, and this resistance zone from where the previous breakout happened could act as a support, continue act as a support, and consolidate or bounce up from here. Change of polarity, there is a possibility of that seen in the weekly. Coming within candlestick on the daily, you can see that it's a bearish engulfing that happened the last trading day, completely engulfs the previous candle that's indecisive doji. And the Banknifty right side, you can see that it's a candle that is inside bar but a green close and a pin bar. A pin bar or a hammer could turn out to be reversal of the ongoing trend, which is on the downside. A reversal from that move that it could move further. It's not confirmed, and it's not at the very bottom also, but it can give some assumption of the upside move if the price moves above this candle's high. Otherwise, if you do look at the daily channels, you can see that Saturday was no change in the normal trading day. Saturday was working or a live trading, and next Monday, which is supposed to be working, is a holiday. Is declared a holiday on Friday, last Friday. So that way, if you look at the last 6 candles, you can see that it was bloody volatile on both indices, with a new all-time high made during the same week when market fell sharply, thereby trapping the bulls. And it moved up, then nose dived down, and then recovered half of that. Same with Banknifty also. Moved up, trapped the bulls, nose dived sharply with 1,500 points drop, big drops in the recent times, and finally recovering some of it. This is the Bollinger Bands that you're seeing on the daily. Shows that Nifty is completely into consolidation or contraction of the bands. That's sideways movement ahead with the bearish bias since its price is below the median. While Banknifty, it is showing expansion of the downside, which indicates that more further downside could happen on that index. So it's more bearish that way. Let's just come to the wrap up first. So basically Nifty trapped the bulls, fell sharp, went volatile, and recovered some of it, and so finally it made a bearish weekly engulfing. We have seen that. So 838 points, that's nearly 4%, 3.79% of fall, one of the biggest falls in the weekly in the recent times. But Banknifty did the similar thing, trapping the bulls, engulfing bearish candle, and fall even more, near to 5%. That's 2,300 nearby points, 2,295 points down in a single week, one of the sharpest falls in recent times. Same time, remember that we had a rally of 3,317.5% before this 800 points of downfall that has happened. Sounds reasonable. Banknifty does not sound that reasonable because 6,500 was the move, 15.5% that happened on the upside, after which this correction of 2,300 points has come in, a sharper correction there. Banknifty has closed below the weekly exponential moving average, while Nifty is still above the 20 weekly exponential moving average. The total rally is coming to 26% nearby from the previous major swing low, while it's 31% of the Banknifty previous, from where we had multiple flag breakouts in the cup and handle and all that. Daily time frames, we can see that it is a volatile gap up, trapping the bulls, sharp north dive, gap downs, and then some recovery. Finally, Nifty closing 50 points flat negative, while Banknifty closing positive 0.78 on the last trading. We have set like 357 points up. That's a summary. So finally, the correction has come in, which is overdue, and market has gone volatile. And this all happened following the HDFC Bank results that came in. That was taken badly by the markets, and it trapped the bulls. So the correction overall now it's at 6.5%. The Banknifty, and the Nifty it is 3.8%. Banknifty probably has done a fairly decent corrections, but Nifty is only less than 4%, 5% still. The question is, will Banknifty continue with this correction, and the Nifty will join into more correction or not? That's a question that we'll have to try to understand. All the bands are contradicting, with more bearishness on downside and sideways movement on the Nifty. More bearish on the downside on Banknifty, I mean. So let's get back and see the support resistance levels. The first resistance on the Nifty would be the gap that's formed while dropping down. It's 21,969. After that, 22,123 all-time high with the next resistance, and then 23,250. No, it can be anything because it's a uncharted territory about that. Similarly, downside supports would come at 21,569, which is a. So the first is the 20 exponential moving average. It's 21,569. If that's breached, just managed to close above that. If that's breached, then you have 21,300, where the previous swing low is there, and it also is in confluence with the Fibonacci 23.6 retracement. And if that's breached, then you have 21,000, it's a rounding number, and a 50 exponential moving average, and a 61.8 Fibonacci extension, and a 38.2 Fibonacci retracement. So it's a confluence of that. So 21,950, 900, that zone. So that's a major support that's going to come if the market is going to come back down again. And if that's lost, when you come to the gap support at 2702, that's Nifty. Banknifty similarly on the upside, the resistance will be at the 50 demo, which at 46,500, and up after that 47,000 would be at exponential moving average 20 resistance, which is in confluence with the 23.6 Fibonacci retracement, now acting as a resistance. After that 48,000 is where the major, which is a gap, is the major resistance, and then all-time high at 48,636. Downside, the first support will come at 100 exponential moving average at 45,700 zones. If that is breached, it can go down as much as 45,000 and 44,950. That's one by a gap, as well as a rounding number resistance there. So 200 exponential moving averages are coming at 44,500, and anything below that will be disastrous. That's already keep a close watch. 44,550. Will that breach the 200 exponential moving average or not? Right. So that's what the support and resistance looks like on Banknifty. Let's move ahead and try to see the momentum and the trend. Left side you have the Nifty weekly and Banknifty weekly. Right side you have Nifty daily and the Banknifty daily. So you can see that Banknifty has lost the weekly or the medium term momentum, also lost it into a sideways, which lost the bullishness, while Nifty is intact bullish on the up on the medium term or weekly charts. In the short term, both have lost the bull zones, Nifty and Banknifty. Nifty is in sideways, but Banknifty lost even the sideways and it dipped into the bear zones, but managed to climb back on the last two trading days to the sideways above RSI 40. So that's positive. So if you look at that, it's sideways on short term and still bullish Nifty on the medium term, sideways again on the medium term Banknifty. So that's a summary. That's what you see here. If you look at the ADX trend, you can see that it's turned bearish in Nifty and the Banknifty, but that bearishness is increasing in the case of Banknifty and not in the case of Nifty. But in the medium term, if you see the ADX or the trend indicator remains to be bullish on both the indices, right? But that bullishness is mildly falling in the case of Banknifty. So overall, the trend remains to be much more weaker on Banknifty, and the trend in the short term is confirmed to be in the bear zones. That's about momentum and trend indicators, what they say. Now we will see the volatility analysis with the help of India wicks and the open interest after that. So volatility can be measured with the help of Bollinger Bands. We've already done that. Now India wicks is greed and fear indicator spiked up 5%. That's on close to close basis, but during the week the India wicks spiked 19% on the upside and then went as low as minus 10% or 9%. So that was a kind of volatility within the volatility index that happened last week. Hugely volatile. But finally, at the end of the day, it managed to close only 5% up and 13.8 if you look at this. So VIX has been spiking up, but it still is in the low volatility. The implied volatility of the India VIX against the realized actual volatility in the market, the difference or the spread, we've seen it still around 17%, which is not in the mid-range and does not favor too much for the option selling. It's not favorable basically. Doing the open interest analysis of the futures, you can see that there is a short build-up that happened in the Nifty, while a short covering happened on Friday on the futures SOI on Banknifty. So Banknifty has shown a positive close on the futures SOI. Now looking at the options SOI for the next monthly expiry at Jan 25, 2024, put call ratio is bearish actually, 0.74 of the Nifty, 0.69 on the Banknifty. Not that great. So options OI is negative. Futures OI is also negative except for Banknifty showing some positive short covering moves. You can see the huge resistance on the call side on both indices that shows the market is bearish. Now where do the supports reside? The highest put rating is seen on the Nifty at 21,500. The second support is at 21,000. 21,000 and 21,500 is where market could move downside. And the upside, it can attempt to move to 22,500, which is crazy. I don't know why the call writing speculation has gone to that extent, but that's where the highest call writing is seen, and the second highest is at 22,000. So there are option writers who believe that the recovery also could be sharp enough. So 21,000, 22,000 is probably where the second highest support resistances that can be inferred from this probably. Banknifty 46,000 is where the highest put writing is seen, supports are seen there, as resistance at 48,000. Sounds reasonable, but wide range, 2,000 points is what the market option writers are saying. Second highest support resistance is at 45,000 and 50,000. Very wide range speculation. Yeah, so that's one option futures options, those are the levels. Correlate that levels with that of what we have understood from the charts, and then place your bets on probability of supports and resistances, what we get. Now let's study the different industrial sectors that contribute maximum to the indices. IT sector is the only sector that went up last week. There was 0.4 flattish up, but that was the only sector that has moved up last week. Rest all other major sector indices, metal, auto, pharma, FMCG, realty, all of them seems to have fallen down. It's closed negative last week. But if you consider the short-term momentum and the long-term momentum and understand the markets, then we see that IT sector, auto sector, and the realty sector are still both placing long bets because they're still bullish on both the time frames of short-term and medium term. But otherwise, metal, pharma, FMCG, all these sectors have fallen sideways on the short term, thereby making us to wait for some more time to take long positions for the short-term momentum also to catch up. Right, so it was a big fall week that happened. 1.8. It was not a big fall, but you see that. Yeah, so that's understanding there to make out from the sectoral trading. The big fall was only in the banking index. The other sectoral index is only 2% down. Auto only flat, less than 1%, 0.5% down. Pharma 0.5% down, less than 1% down. FMCG, reality, of course, it moves also that much, so just 2% down. So there is no big fall that is there in any of the major indices, major industrial sectoral indices, other than the Banknifty. So the Banknifty fall majorly contributes because of the HDFC Bank's fall, because it's contributed maximum to both the indices, Banknifty and the Nifty. So that is a understanding that we can. Yeah, so this is where the sectoral analysis charts are. This is how it's placed. So the IT sector, you can see that its momentum is in the bull zones. For the metal also, it's in bull zones. Auto, FMCG, pharma, all of them are showing momentum in the bull zones. On the medium term, all of them absolutely intact. Right? So that's very much evident. Nothing has happened to any of those yet, which could give hope for the bulls. Now looking at the industry heavyweights, the heavyweight stocks that contribute maximum to the index. HDFC Bank, that is where everything happened the previous week. Look at that wide range bearish. That's 10% or more for 10% or more. 1650, it has fallen to 1450 nearby zones, 465 or something. That's a kind of sharp fall. This contributes. The HDFC Bank has been contribute 15% or something to the market, and it is the Fyers who sold this, and it's evident from the next slides where we'll understand how much they sold. The majority of the selling might have happened on this. So it is fallen to the bear zones, trendless momentum, and trend has crossed over to the bear zones on the medium term weekly charts. HDFC Bank was formed a trap candle. We were at hammer at the very top. Momentum is intact. HDFC Bank also momentum is bullish, and it should close green on the week-to-week basis. Nothing has happened there. Infosys, look at this. It's a resistance zone. It's doji. Right, the index did not fall sharp. Last week it closed up actually, but some reversal obviously will happen when sharp falls or panic hits the market. That happens, and that's what is reflected. Red candle formed on the TCS as well. Grab Bank again, it's a contrast stock and it is consolidating up and down within that range. ITC, it's a doji candle. The momentum is bullish on the medium term. It's well within that flag, ready to break out any time. So absolutely nothing has happened to any of the heavyweights as compared to the previous week on the week-to-week basis, except for the HDFC Bank. So the culprit of last week's correction is exclusively HDFC Bank, you can say. from the understanding of these sectoral indices as well as heavy weight stocks that contribute maximum to index. Now this could turn around next week. No, it could spread to the other stocks, and then sell-off can continue and intensify, and all that can happen. But as of now, all looks good. It is only a one stock event probably. Look at this. Institutional participation it is in FIS are net sellers of 22,000 crores 970 in the cash market. It's a kind of selling. Such kind of selling in a weekly basis has not happened recently. Domestic institutions are trying to buy 11,700 crores, but market closed red because of the difference. So net to net, it's negative from the institutions. The institutions were the sellers mainly. Some derivatives, if you see the net long, some move down if you look at that. And if you see the F&O space of the institutional participation, if you can see as of the last trading date, FIS or bearish on futures, mildly bullish on the options. For traders, some of them part of the FIS strongly bullish on the futures and options, but FIS are bearish on the futures and bullish, mildly bullish. So mainly they are negative, they are bearish. That's what it indicates. Now the clients or the brokers indicates that it's a mild, it's a medium bearishness that you're seeing on index futures and options both. That's what you see there. Institutional participation has scored up the questions from the last week, right? So that's what you see there. Moving ahead, so that's a concern. So institutions continue to be sellers is a concern, right? And going ahead, look at the global markets. We would analyze the global commodities, the currency, and the global markets like the US indices and all that. Oil, gold, all of this. Now, begin with the dollar. Dollar has taken a dip of 0.77%. Oh, not a dip, sorry. Dollar has moved up, actually 0.77%. It's less than 1%, but it has definitely moved up. It had moved down nearly 6% and earlier, but this is 1% spike up. So it's in the neckline zone of the cup and handle pattern, we can say. 3.23. It's sideways momentum. It had dropped to the bear zones earlier, climbed back and into the sideways, and then rising up. That's what you see. 103.23. That's the dollar currency for them. USD has actually, that has also moved up. That means it has, rupee has gone more weak. It's 0.2%, that's 0.5% up move at 83 back. So it has been moving around this 83 zones for very, very long time. Because of the central bank interventions, that it is not spiking above 83.5. But technically, if you see, there is every scope of this breaking up the upside. Every scope of moving that to 84. It has been controlled or managed, you can say, USD INR. So rupee remains too weak. A spike in the USD INR has happened. Although, along with the dollar that has moved up less than 1%, near to 1%, 0.8. Right. So that's about that. Now moving at crude oil, it has been consolidated for the last several weeks in this range, but it's at the bottom. It had fallen to the bear zones and climbed back sideways, well within the trend line channel, and that's now 1% up this week if you see. But as long as it does not break out of the channel, it should be fine. Remember that we had fallen, how much? We had fallen quite substantially, 29% from the swing high. If you see, it was a kind of fall. It went even below the 70 or 60, somewhere to 65 kind of levels. It had gone 67 or something. But it's consolidating. As long as it remains in sideways, it should be fine. As long as it does not break out of that parallel channel, it should be fine. Now gold. On the gold, if you see, it's consolidating at the very top. It's a cup and handle pattern, breakout did happen. It hit the all-time highs and then got into sell-off, moved down, and then it's moving flat, consolidating. Now the momentum is slightly slipped sideways. It had done that several times after hitting all-time high, but it's not ready to fall. So basically it's at the top and consolidating. That's what it's doing. So that's about gold. Gold is a hedging instrument. It moves up when the market falls, basically. It has not done that. It has been staying in that same zone where the market was at all-time highs as well. Oil is important for economy. It is also, it's okay levels, you can say. But rupee is where it is weak, and it is being managed by the central bank to be at that level. So that's what is seen. Well, that's a summary of the currency and commodities. Now moving ahead, if you look at the global market, that's primarily the US market is what we track as the market. We're seeing the Dow Jones Index, Nasdaq, and the S&P 500. Dow Jones had broken out. It's an all-time high. Solid green move, bullish momentum. Absolutely. Nasdaq, all-time high. Breakout from the descending wedge. Absolute bullish momentum with a range shift, which is make it even range shift bounce. That's seen. That's make it even more bullish. That's Nasdaq. Now S&P 500 also hit the all-time high. Solid bullish move. Momentum having a range shift concept also is making it even more bullish. So absolute green foreign market is what you're seeing there. So that's making us bulls happy that there is a possibility that our markets also would fall, because the rally that began the December started with inflation lowering. It happened in the US, and US rally and our rally happened parallel, you can say. Right? So that is a plus point for the bulls. Now let's move ahead and see. After having analyzed, we'll wrap it up. Before that, we'll have some action numbers. So two stocks. Bata India is having up and handle. Probably it's, you can say, forget about the cup part. It's a parallel channel. It's downtrending. Momentum is in the bear zones. Trend is in the bear zones, and then actually the volumes are not put in here, but I believe the volumes are also substantially high for the index. If you see the volumes, right, you can see heavy volumes, reasonably high volumes, not that great, but reasonably high volumes. Yeah, you have to put tight stop losses. The volumes are above the SMA, right? So basically momentum has trend has turned to bear zones, and there is a reasonable risk-reward trades possible with tight stop losses towards the bottom of the channel at least. Second one is Navin Fluorine. Navin Fluorine is a chemical stock, and you can see that it's also having reasonable high volumes, and it's fallen down. It is a consolidation breakdown from the parallel channel, right? It is moving trending up, consolidation, and then breakdown. So there is a low risk trade that is possible with tight stop losses, which can give reasonable 1 to 2% at least during this correction or the consolidation, probably, right? So Bata India short, and Navin Fluorine also short, right? Other actionable is simple beer call spread, where we are selling the call at 21,650 and a higher call is bought. So the market is moving down, we'll gain. And if market is further breaking down, we have some. So if it's further moving up, once again the rally continues, then we may have a problem until it breaches the 21,700. Hopefully there may be some consolidation that happens, and does not happen. So accept that in case it breaches that level, but reasonable risk reward and good range and probably a profit, and then it's a simple spread. It's a directional trade, probably, right? So that's it. Next, because it's a truncated week that's going to come. No directional strategies. Doesn't look very attractive premiums. Right, so that's another weekly option strategy action for the next week. Let's just wrap up things. The market did trap the bulls with a correction that came in, but came in with volatility, sharp falls, and some recovery that happened late part of the week. This all happened following the HDFC results outcome. So it has lost the short-term momentum and the trend to the bearish, you can say. So retracement is now around 4 to 6.5%, not much on the Nifty yet. And that has happened from the top of the trendline channel and from the all-time highs of the Nifty. So we are still in the bull rally. It's ongoing, 20% from the bottom. We already seen that it's multiple cup and handles, multiple flags and cup and handle breakouts, what we have been seeing. So all of things are in favor of the bearish. Is the bearish candlestick patterns overall, the big drop in the momentum and the trend that happened on the short term, big selling by the Fyers, bull demand showing downside expansion on the Banknifty especially, and confirmed contraction of the Nifty. Open interest put call ratio stream bearish, and it's only HDFC stock specific event or stock specific correction that has happened. So these are the factors that's in favor of the basically this last point is in favor of the bulls. Excuse me for that, I'll put it here. Let's summarize what of things that are in favor of the bulls. So some recovery has happened with respect to the momentum. You can clearly see that it has climbed back to sideways Banknifty for the last trading day, and VIX is still in the low volatile regime. It has not gone to the 20 levels or something like that. Right, just like how it often happens when there's a crash, it has not done that. It has been hovering around within this 13 and 15 range. So that's in favor. Nifty Bollinger Bands are yet to get rid of this downside expansion. It is still consolidation only that has happened. These markets are green. We've already seen that. Across the sector, bearish is not there. We've already seen that. It is, if you see, it's only the banking index. Other sectors are fallen, but not that sharp. They're still in the sideways, basically. So it's just a single stock here, is what you can say. These are all factors in favor of the bulls. So IT sector really helped the market to move up. The banking index turned out to be turning it into bear zones and bringing it down sharply. And the question is now what? So basically the market has done a correction that is due, and it did it in a volatile and sharp way and found a reason of the HDFC Bank. This is F5 just selling basically, right? And they're selling it on primarily on this HDFC Bank, and on other sectors are all remaining the same, in mid cap and the small caps are all not that hit. So correction is extended sharply to 6.5% of Nifty and still less than 5% of the Bank Nifty. So all the eyes would be if the Bank Nifty would further fall from here, dragging the Nifty also to correct substantially. Would this happen, or would it just settle down and consolidate? First the Bank Nifty and then join the Nifty, consolidate the volatility, and then slowly take up the strength to move further up. So short-term trend has turned bearish, that's for sure. The Bank Nifty has done a decent correction during this bullish rally. You can see, if you have seen that now. So the Fyers are continuing to sell, then we have trouble. And otherwise, if they stop the selling, so if things get back to normal with respect to HDFC Bank, then it should be fine. But then you can see that it is only a stock specific, and then it will come back to consolidation and join the Nifty. So that's what all eyes will be. We know what happens. So look at the support resistance levels and play the game. That's all. So technically, the market is no longer bullish. Well, after the previous week's fall, it is in sideways. Basically, you can say, right? Basically, it's in the sideways from the momentum perspective primarily. But the market view for the next week is neutral, actually, with a mild bearishness, biased towards that. Although I expect the market to be consolidating onto the sideways. And if things go wrong, it may further struggle to. Sell-off comes in, then it may turn bearish. But yeah, it's mild bearish only that I am looking for. I may go wrong, but that's a view. After such big sharp falls, even if it is turning to bearishness later on, the next few days may be consolidation mostly. Right? So the global cues on recession, fear, inflation, interest, war, COVID, all these things could bring in black swans, and then every analysis could go for a toss. Right, so you gotta be careful of that. Manage your positions size, manage your risk is all that is in our hand. The rest market can surprise you anytime, trap you anytime. it's up to the market. But play with have a market view and play with the probabilities of resistance and supports. But if things go wrong, you should have taken care of that by managing your risk while taking the positions, right? That's the only thing in our hand. So next week, 21,000 and 21,850 would be the range for the Nifty, and 45,000 and 47,000 would be the range for the Banknifty. So as long as this 21,000 and the Nifty and 47,000 is maintained, then only we can hold for a continuation of the rally. Otherwise, we may be remaining in the consolidation or even falling into the bear zone. So IB2, we already seen that it's not in favor of the option sellers with respect to the India VIX. With respect to the volatility, it's not that much favor in the with option sellers. We've already seen that. So don't carry naked positions, manage your risk, cut short your position size with the VIX spikes up, have hedge positions always. As of now, it's still direction. It's not directionally bullish. That has changed, right? With respect to the traders, but it's a sideways that is happening. The sideways could turn out to be directional on either of the sides anytime. So be cautious and stay watchful about that and play it safe. You can also use this dips or corrections that comes in as investment opportunities in quality stocks in SIP mode. That's another way of looking at it. You can use of cash equivalent pools or forward calls and all that strategies. Playlist, check out that. There is videos on that separately. So options can also be used for getting regular incomes while the market is crashing. Also, there are ways to play that. So check out that. That's all I have for the next week. And holiday tomorrow, Monday. An expected holiday. Enjoy the day, and come back to trading on Tuesday. Right? If you're not subscribed and watching this, please subscribe and share to friends and colleagues. Put their feedback, comments, and share to maximum so that it reaches out more. Also, if you have regular postings on the Twitter where we have technical analysis, charts, and a lot of things posted, so subscribe to that as well. Twitter, X, and all of these other channels in sporting game. That's all. Happy trading, happy learning, happy investing. Bye bye.